joining us. Give it a couple of seconds just to welcome as many of you in as possible before we get going. Ed and I were just saying it's nice. This is the first webinar of the year that we've started and it's still light outside. We're planning on just 30 minutes this evening, so it might even still be light when we finish, but at least it's light when we start. So
that might be optimistic.
Cool. Well, I think we'll get going because, yes, as I say, we want to aiming for another quick fire webinar. So welcome. This is the second in our more quick fire webinars of the year. The aim with these sessions is to really try and give you as much useful information, useful insights as possible on one key topic and show you how to put those insights into action on the platform. So this evening's topic is quite seasonal, how to get the most out of company financial reporting season. The reason this is a seasonal topic is because we're roughly in the transition phase at the moment between trading statement season and financial results season. And I'm joined by Ed this evening, and he's put together this this diagram which shows quite why now is a good time of year to be talking about financial results. So you can see here in the orange, this is when companies, well, this chart is from 2024, and this shows the dates in 2024 when we had financial results. And there was this real spike towards the end of March, and then again towards the end of September. The reason companies, well, most of them tend to report their financial years in line with the calendar year, which means their financial year ends either in December or in June, and their interim results are the opposite of that, which means we get a lot of results in the sort of 3-month window after that financial year end. In the blue here, we can see the trading statements. So in the UK compared to the US, companies are only obliged to report their financial results every 6 months rather than quarterly. Many of them choose to fill the gaps in communication with a trading statement. And we get a lot of those at the start of the year. Companies like to report on the Christmas trading period, things like that. So, which is why on the 5th of February, we've got quite a lot of really interesting insights to share with you about that sort of trading update season, the one just gone, and the insights that you can take away from that. So quick agenda. We're going to run through the insights that we found in this trading statement season and the previous ones, and show you how these insights can help you make decisions on what to do with stocks. Ed's here to run through some case studies. Ed's spent a lot of time in the last few weeks looking at the data, looking at these trading statements, and he's got some really interesting research to share. I will just say at this point, some of the research is work in progress. We've got a few cases where some of the sample sizes are quite small. But we're really finding that these results, which are UK-based, are mirroring the insights from wider financial literature, which is really exciting, and we're excited to keep adding to them as we keep digging. So keep an eye out for more.
And adding to the product too. So lots to come.
Absolutely.
No promises.
Absolutely. I wasn't sure if we were supposed to be making promises, but we've said it now. We've got
get in trouble all the time for that.
Now we've said it, we have to do it. So. Yeah, we'll have a look. We've got a few case studies here, as you can see, having a look at some of the key figures in some of those case studies. And we'll try and address some of your questions. So, yeah, as I say, half an hour. We may run over if we've got a lot of questions. We're not rushing off to anything, but yeah, just so you've got an idea of what's coming.
Oh, and just to add one point, Megan's going to be running through most of these slides, but yeah, right at the end, we've got some slides of some of the most interesting stories from this trading statement season at the end. So do stick around for that. Absolutely.
So yes, as Ed said, just quickly, a bit of an overview of the insights, I suppose, and what you can take away from them. So starting off with what is a trading statement. So a trading statement, as I say, management's opportunity outside of results season to update investors on how the company is performing. These announcements let investors know whether the company is trading in line with expectations. Now, generally, expectations refers to collective market sentiments about a company's future performance. So the expectations are derived from what the company management say about their expected future performance and also what analysts are forecasting for the business. So the numbers, albeit made up, but they're numbers on which a lot of the company's current market valuation is currently based. So the trading statements will let us know whether the company is trading in line, ahead, or behind current expectations. Now, if the company is ahead, share prices tend to correct upwards on the day of the announcement. This is what we're calling the jump. And if they're behind, this is a profit warning, and it tends to result in a share price slump. Now, I think looking at these share price charts, there's probably a temptation, and I'm sure a lot of you have felt it, to bag profits from an ahead of expectation trading statement, like in the green, and buy the dip of a profit warning. But generally speaking, both of these two behaviors are wrong. And this is for two key reasons. The first is that the momentum from updates often continues in the same direction as the initial price movement. And also, both positive and negative updates often repeat. Now, we're just going to run through these two phenomena in turn. So the first, that share price momentum from both positive and negative updates continues. Now, this is something that we have found in our research. So that after an ahead of trading statement, and then we've seen that initial jump, we found that share prices tend to drift upwards in the weeks and months after that positive announcement. And then the same is true on the downside. Share price will slump after a profit warning and then continue to drift lower. As you can see from this chart, this is reflective of the wider literature. This is a 2008 study, and it shows that the returns in the days and weeks and months after a positive or negative trading statement. So in the blue, the share price returns after the most positive earnings surprises, and in the red, the share price returns after the most negative earnings surprises. You can see they're far less impressive. So the second phenomenon here is that both positive and negative updates often repeat. Now, this chart actually comes from our own study, 10 years of trading statements analysis. And you can see here in the green that almost a third of the companies which have announced significantly ahead trading statements announced another ahead of statement in their next update. Now, there is a reason for this. Ahead of announcements can be a sign of improving operating leverage. So where companies' sales and margins are both expanding simultaneously, they're more likely to beat expectations again, and and this is likely to repeat. So there's rationale in the finances of the companies as to why these things can repeat. The same is true in the reverse. This chart comes from our profit warning research from a few years ago. And we found that a third of companies which warn on their profit do so more than once. This backs up a lot of the research, which has shown that profit warnings do tend to repeat themselves. And again, there are reasons for this type of statement to repeat. Weakening or economic or market conditions play havoc with the company's ability to announce positive results, and also faltering financial health of the company. So research has found that a lot of companies which report these profit warnings are also experiencing a fall in margins, and that margin fall gets worse in between the two sets of profit warnings that they've announced. So with these phenomena in mind, and with all the research, we've put together 3 rules which you can take with you into your next trading statement season. I'm just going to run through these quickly in turn. As we've said, number 1, price momentum continues in the same direction as it did on the day of the announcement. So rule 1, look for the companies which have announced or are on a streak of announcing a positive update. Secondly, we have found that the larger the first day jump, the stronger the price returns are there in the following months. So this chart from our 10-year study shows that companies which reported a 5% increase on day 1, on the day of their announcement, reported an additional 7% in returns in the 6 months following. The companies which reported a 20% increase on day 1 reported a further 20% increase in the following 6 months. So rule 2, look for companies which have enjoyed particularly big share price rises on the day of their announcement. And this leads on to the third finding, which is that significantly ahead or below expectations experience the strongest drift. So this chart, which is a similar sort of trend as we saw in the previous chart, we can see that the companies that announce significantly ahead, so these on the right-hand side in green, had the bigger first day share price jump, and they also had the highest returns over the 6-month period following. And in the red on the left-hand side, these are the companies with the phrase significantly behind in their announcement. So those with a 10% share price fall on the day, followed by a 15% decline over the following 6 months, 20% decline on the day, 20% decline over the following months. So rule 3, look for companies which are using the phrase significant in their updates. So there we go. These slides will be available at the end. So there are all the 3 rules in one place. So some case studies, Ed. Just to clarify at this point, these case studies are case studies. They're examples rather than used to illustrate the point rather than things that are happening right now. But we'll take you through, as Ed said, some current examples later. But case studies for now, and this one I know you're interested in, Ed, is New Group.
Well, it's one I still have some family money invested in this, and I think U Groups are. We were talking about it a week or two ago in the podcast because it's actually in a couple of the model portfolios, but I don't expect the returns this year to be a patch on what they were a few years ago. And U Group really. It had, and this is a case study of essentially repeating announcements. So we wanted to just sort of show an example of this, and there are many of them. Whether you look back at Games Workshop and its great period in 2017, Greencore last year, Keller Group, these stocks. There've been lots of these which have these repeating ahead of expectations announcements. U Group in about late 2022, it had really good results. And then it started coming out with a string of announcements saying, hey, we're significantly ahead of expectations. And you can see here, I think the first one was October, November 2022. And then there was another one in January 23. And I bought for the family in Jan 2023. And it was actually at about £6 then. And it had gone up, I think, probably tripled. Megan's got a stock report from back then, and you can see in the chart on the left from September 22 to January 23 it had almost tripled. And I have to say I had a lot of vertigo buying there, but it's now tripled again. So it's and I've seen that happen before, for example with Dark Group way back in 2013, and sometimes you get these really strong trading momentum businesses that can do it again and again. But what we're really talking about here is that often significantly ahead of announcements have another ahead announcement following them. But this one kept saying significantly ahead or substantially ahead on no less than 5 separate occasions over about 14 months. So it's something to look out for when you see a company you own or even you're thinking of owning that has a really strong trading statement. It's often a signal it's going to get better. And I've seen too many times, as Megan said in the great presentation, that people sell on these announcements because they sort of go, phew, it's gone up, and then they pocket a profit. But often that's, you've got to let your winners run. And these are the sorts of winners that when they're, on a streak, you want to hold them. Unfortunately, U Group, I think, came out about a week or two ago with a slightly behind on revenue, although profit was slightly ahead or in line. So it wasn't really a profit warning, but its momentum is not as strong as it used to be.
Yeah, it's a good point. I think especially with a company like U Group, obviously it had that really strong upward trend for a while of repeated beats, and now that trend seems to have stopped. We can see if we scroll down here, we had this phase here of earnings being upgraded, and now it's been quite flat for a little while. So potentially.
That chart, just to reiterate for anyone who doesn't know, that shows the trend in the earnings forecasts from the brokers or the analysts in the city. So when that trends up and to the right, it means that for the last year or so, they've kept ratcheting up their forecasts for the next year or two. And that's a really good sign. If the analysts keep having to raise their numbers, it means it's got really strong earnings momentum behind it. It's real powers a share price.
One company, the next case study, I suppose, where this sort of ratcheting up continues to happen is your next example, Filtronic. It's been a great little success story for lots of private investors in the market in the last year or so, and it came out with an announcement that it had a contract with SpaceX, and that contract has been transformational for the business. And I think it jumped on, I'm not sure if that was the contract day or that was another announcement day, but it jumped 48% on that trading update.
and that huge jump, you'd think if a stock jumps 48%, you're just terrified. You don't want to buy it. But from the close on that day, it's gone up 97% since. And it's had a couple of other, I think two, maybe three other ahead or significantly ahead announcements. There was one in December and another one in January. And then it just reported its results. Roland was a little bit, he was amber on it because he sort of understands, if you scroll down a bit, that the numbers are, the expectations for the next year or so are very strong, but they've got a large concentration with SpaceX in their revenue profile. And there is some expectation at the moment that profits will actually fall in the year after this. So there is some concerns there. But I think what's really interesting is that, when a company has trading momentum and strength like this, and their products are really clearly doing very well, often the predictions and forecasts can be behind the curve. So I'm really interested to see how this one unfolds. And it's a lovely kind of example of how that big jump continues. And actually on that slide, significantly ahead slide that you had in the presentation, the very top set of them, I think there were only 3 companies in that study that were in that set, which I think was Synectics, Concurrent Technologies, and Filtronic, who all had very big jumps and have all had really strong share price appreciation since. So I'm not saying, obviously, all the charts we show are based on averages. So there's always a distribution. Some shares that pop up a lot, do fall. So there's no dead cert in investing. It's always a bit of a, you have to play the averages.
Which leads me quite nicely to my question, actually, about Filtronic. And obviously, as you say, sort of, it was a SpaceX contract which really propelled the share price and also has helped to propel these earnings up and up and up. But I suppose there is a risk with companies like Filtronic, which are heavily reliant on one customer. And we did actually see that towards the back end of last year with Solid State. Similar sort of situation, but in reverse, a company that was has big contracts in the defense space, and when that large customer pulls away from the business, it leads to sort of a string of quite negative updates from this company.
Yeah, so hence that large share price drop. Was it December?
One in November, and then we had another one. And then we had another one first one here, next one here, and then sort of still negative momentum. But the case study you've chosen to pick on the negative, on the downtrend, is Sanderson Designs. So talk us through what's happening.
Well, I'm sure there may even be some people on the call who own Sanderson Design Group, because they own William Morris, the brand, which has all those lovely wallpapers. We have some of it at home here, and it's a very, very well-known and famous brand. And I think they've got some other brands as well. And this stock did fantastically well a few years ago. It went on a huge run. But it's been a very difficult last 12 months. I think that a couple of those red lines are results and the updates that the company was giving on trading, interim and finals, but also a couple of profit warnings. So there was another one, I think, in January, and you can see that the share price has just been an ongoing decline. And again, it shows you that these sorts of, whether it's ahead or below, they often repeat themselves. And one of the biggest lessons in investing, and we did this big profit warning research a few years ago, and I think you can find it on the site. We've got this fantastic study of 245 small cap disasters. And we found that really the main rule that comes out of that is sell on the first profit warning. Something Jim Slater once said, you want to be first in the queue of disappointed enthusiasts. And I love that line, because it takes a long time for people to let go of shares they're really attached to. And, there's a big difference between a great company and a great stock. And sometimes a great company with beautiful products like Sanderson Design Group can have a really poor run. And again, maybe we'll get to the bottom and it will be a fantastic buy again. We were looking at the numbers earlier, weren't we? I thought this was quite interesting. We were just looking at the stock report, and I don't pretend to be an expert on the company. I'm really not. I'm a stats guy. But I noted that the revenue had dropped from 112 million down to about 101. So it's only about 10% drop in revenue, but the net profit has more than halved. And so you've got the profit line is more than halved. So revenue's down sort of 10% or so, but profits are more than halved, and that shows you what we call operating leverage in reverse, I guess, which is that the profits fall a lot faster than the sales, and because the share price is dependent on the profit number and the earnings per share, it can really hurt the share price. So you've always got to be a little bit aware of that. But it can happen the other way around as well. When revenues start kicking off again, you can see a lot of operating leverage on the other side. Anyway, I don't know the specifics of Sanderson Design. You have to go and dig through Graham and Roland and all the market analysts' work in the daily report to get the details. So
very good example, as you say, especially these numbers, the sort of falling but not too fast revenue and really quite rapidly narrowing margins.
Yeah, and it may be they've been discounting and other things. I don't know the specifics of this case, but it's something, as a shareholder, worth pointing out those fantastic little new things that we've put on the chart on Stock Reports, where you get those little pop-ups and they provide links through to all the editorial we've done. So it's a really quick way to go and find all the good analysis the team have been doing over the months and years.
While we're on new parts of the site, we also have rolled out something new for a financial reporting season, which actually came into its own today. We're very pleased with this. MadeTech actually announced results today and announced results, but also interestingly announced ahead of expectation results, which is quite unusual. But large share price rise on the day of, which is interesting in and of itself. You can see here it was most viewed in the community today. So MadeTech and GSK, actually the two companies with financial results today. And we can see here that these were results by this new little feature here. And then clicking into the actual stock report, we've also got a banner up here to show that these were half-year results from MadeTech Group. Now, as I say, financial results slightly different to a trading update. By the time a company has announced financial results, we should have a pretty decent idea of what's going on at the business. Any nasty surprises most likely to have been delivered, but that doesn't mean there's not an awful lot of very useful information. Now, I thought I would just very quickly show you quite how much useful information. Obviously, GSK is a massive company, but this is a 53-page document, relatively overwhelming for anyone looking for insights. But just quickly to show you some of the key things to draw out if you're trying to do it a little bit quicker than trawling through 53 pages one by one. So the first thing, which I think is quite important, is to look back over a period of time, and over 5 years is probably quite sensible. And we can see it's quite useful at GSK because we can see that sales haven't really gone anywhere in the last 3 years. The results that were announced today hasn't quite updated yet, but it's roughly in line with what the expectations were. But we can also then have a look. We can go into the accounts. We can have a look at the cash flow statements, see if there's been anything significant that's happened in the last 5 years that may or may not have altered the way that these the revenue figures are reported. And we can see, scrolling down here, some cash from investing activities and cash outflows in 2020. That was when the company started rolling out its consumer healthcare division. So may have had an impact on revenues. I'm flying through this. There's a lot to unpack with GSK's revenue results. I'm not going to go through it all. Actually, Roland did a very good job of that today. But one of the things that is quite key in reporting season is to have a look at the numbers before the management statement. There's a lot of fluff in what the executives can say. They tend to put the numbers they want you to read right at the top. So scrolling down to the income statement, the balance sheet, the cash flow statement, we've got some really great guides in the academy which help take you through that line by line. And also having a look at what the management has to say about the outlook. I think that's where the results can provide more than what has been said in previous trading statements. There's slightly more meat in what they're looking at for the outlook. So there are some key things that I like to look at in results season. And we're going to do our best over the next few weeks as we really enter that busy period to cover financial results and look at the key numbers, the numbers that matter the most. So moving on, some interesting insights from the reporting season so far. Ed, I'll hand over to you to.
Yeah, well, we pulled out some sort of brief case studies. They'll be in the deck, and just on the themes of the points and the rules that Megan was talking about. Here are a few companies that have announced again in January and ahead of expectations or significantly ahead after having done so in the recent months. So I think Currys, again, that's a large retailer, and you'd think would be quite impacted by, Rachel Reeves, hit on national insurance and all of that. But they came out and actually had, really good trading statement again. And there's quite a story developing there. Journeo, small cap, it's a very small company, but they've been doing well, only slightly ahead. They weren't sort of significantly ahead or anything. Filtronic, again, like we've already spoken about, they've actually just released results, so it fell a couple of percent on the results because, as you can see, the price had already sort of popped up on the trading statements. And, I wouldn't say it's buy on the rumor, sell on the news, but that's why often you do see a sell on the news, because the trading statement's given the game away. Trufin, an interesting one. It's got an amazing game called Balatro, and they're making quite a lot of money from that. But it's again a small cap. Audioboom, a very low ranked share that actually has had the most ahead of expectations announcements in recent months. It's had 4 on the trot. That chart looks terrible. That's it. All these charts are 3-year charts on these slides, by the way. But on a 1-year view, it looks actually it's got a really uptrending chart, and that's been one that's sort of broken a few hearts over the years. And there's another one, distribution finance. I don't know, but I know Graham's commented on it. So these are some which have just had these sort of serial announcements which are ahead recently, and so we just thought we'd share them. And then the next slide, we've got, what have we got on the next slide? Some of the jumps, don't we? You got any questions on that one before we move on, Megan? No.
I can do. I mean, I think looking at this Audioboom situation, I think this is a really interesting situation. Obviously, this was quite a big pandemic winner, Audioboom. Yeah. Lots of people doing podcasts, lots of people launching podcasts in the pandemic. And the trend didn't continue, fell off a cliff. But yeah, as you say, if you were to zoom in on this sort of 1 year, that looks like a much more positive chart. It'd be really interesting to see how I can't see it reclaiming these kind of heights, but
no.
Who knows? And yeah, as you say, Currys is the other really, really interesting one. I mean, not many retailers with charts like this at the moment. And really high ranking share.
Yeah, which we like. I know. I mean, I think one of the interesting things about all of this work into trading statements is it's kind of an orthogonal approach to the stock ranks. The stock ranks, we know they've worked very effectively over many, many years, the last decade, really good returns, but these are real news triggers. And one thing we found is that ahead of expectations announcements are actually a kind of a predictor of an improvement in the quality rank and the stock rank in future. So a lot of the work we're doing around the news is really sort of highlighting these kind of behind the numbers kind of stories, which I think is really interesting.
There is actually a question which might be worth asking now that we're on this sort of repeated slide. So the question is, when you say ahead of expectations, there's a high probability that it will continue or repeat in the next trading update. There has to be a point when it will announce in line or potentially below expectations. Yeah. At this point, would the balanced probability be a reason to sell? What other indicators would you look at when this change has happened?
Well, I'm not sure if I'll answer it exactly or not, but when I found that basically most of the return and the most powerful return comes in the first 6 months. And that's very similar to the academic research around earnings surprises. So it's the next 6 months get a significant sort of power for the share price in on the average case. And what we've actually found is that I think it's on average about 110 days after a significantly ahead announcement. That is the sort of point at which they might announce another ahead. And what I actually analysed whether if you kept holding when you get another ahead announcement, what the actual analysed return is, and it's much, much higher. So I think, we often also see sometimes you get an ahead announcement, then you get an inline, then you get another ahead, et cetera, et cetera. So certainly if you get a profit warning, you've got to sell immediately, but it's very hard to say. I think it's, there are different time frames in investing. One thing I would say about ahead of expectations announcements is they often can signal the start of a real change in story, or certainly significantly ahead, can. We saw that with Games Workshop. We saw it with Judges Scientific. We've seen it with some of the biggest multi-baggers. And, you know, often it really kind of marks a point where something has really, really dramatically changed. And then, you know, if you've done your fundamental research, you'll know whether to hold for the long term. But I wish there was a kind of a really simple rule. But I mean, I do know the kind of the 6-month return time frame is very good, but that's very short term for most investors. So most people will want to hold for longer.
Short term, but then I suppose there will be another announcement after,
exactly,
in that 6-month window, whether it's another trading statement or an actual result, whether it's actual financial results. I think Games Workshop is such a fantastic example because there's a lot there about the way in which management manage expectations. They're very rarely are they having to announce that they're falling behind because of the way that they deliver those forecasts to the market. They don't really say numbers until they're quite confident that those numbers are going to come in. So they very rarely, they haven't in the last several years had to warn at all. Which is
if you ever want to look at probably the best if you want to read company reports, go and look up Games Workshop and read their interim results and annual results. They normally have no gloss on them, and they are an amazing read every time. I can't recommend it enough. They are brilliant. If you want clarity in company communications, they are the ones. Right, should we look at some jumps?
Yeah.
So this is just some I've picked out, which have been big jumps on the day, and I think interesting stories for private investors. So there's a few there which are high ranked. McBride has been a really good winner for a high ranked share over the last kind of year or two. These are again 3-year charts. Reach PLC, which used to be called Trinity Mirror, and it's a company where if you land on their websites, you just get hit with so many adverts, and they've got so much traffic, and they make a lot of cash flow from advertising, and they've got massive pension liability. But every few years, Reach sort of the share price ends up quadrupling. I don't know why. It just seems to do it again once every sort of 5 years. It will go on a big run, and I think some tip sheets get behind it and things like that. But anyway, that had a pop up 21% the other day, and you know, it had very strong trading up to December. And it's always kind of a litmus test of what's the advertising environment like, and maybe there's improvement there. Trustpilot is one of Graham's top watch list stocks, and he's been very right on that for the last year or two. We use Trustpilot in our business, and it again had another 17% rise the other day. You mentioned Made Tech, that was today, and had a really strong rise. I don't know the company very well myself, but I know that they've got a lot of exposure to sort of government and digital and all of that. So they're a sort of consultant, and maybe they're riding the a lot of the money that Rachel Reeves is spending. I don't know, but that could be quite a trend. And then, you know, we know Wix is sort of building supplies, and Tribal Group's quite an interesting one. That had a bid, I think, rejected at twice the price it's at now. And I think last week it popped up 21% and said it was, I think it might have said it was significantly ahead of expectations. So they do education software. So there's quite a few there to go and dig around in. And obviously, every single day on the site, you can see which shares have popped the most, and often, most of the time, we've got commentary on the stocks. So now that you know the rules that Megan set out, we know that these sorts of situations are worth watching. McBride's up another 10% since that jump. Reach has gone sideways. The various stocks have sort of, it's not a very bullish period in the market, but some of them are behaving like the model would suggest through the slides earlier.
Yeah. I think the ones of those that leaps out to me is Trustpilot, as you say. It's one of Graham's watch list stocks, but I think it's also one that ticks a lot of the boxes that we've talked about before in the multi-bagger work that you did. Ed. It's got quite a strong moat. Trustpilot is, I mean, with the exception of Google reviews, one of the only players in this market, and yeah, it's in quite a defensive position, and yeah, I mean, never really taken off. It's one of the UK's arguably tech companies, which is quite nice to have.
It's also it is on a forecast P of 100.
Well, that's the thing about tech companies.
I know, but it is actually an amazing business. They have They really do have a very strong position. And I think once you recognize the brand, you start seeing it everywhere. So you'll start seeing it on all the adverts for companies everywhere. And I think companies invest in it themselves. They try and get as many reviews as they can. And so it is a very defensible position. And there's lots of also rans in that space. But for some reason, Trustpilot has become probably one of the most trusted review sort of star rating systems out there. It's such a it's an amazing thing they've done. But again, valuation is pretty punchy.
Yeah, it's an interesting point that you make about valuation, though, because obviously it's a reason that a lot of people give for not investing in stocks like this. And there's been loads of examples. I mean, 100 is particularly punchy, but I suppose that this sort of earnings research that we've done is kind of counter to that value argument, where there is an exceptionally high price to earnings or cash flow yield or multiple for the company. But then if they are repeatedly beating expectations, if they're repeatedly doing better than what the market is expecting, then that valuation doesn't matter quite so much.
Yeah, absolutely. I wish I'd bought it a couple of years ago, I have to admit, because we use it in the business and I really regret not buying it, but there we go.
Shall we move on to ones ones to avoid, potentially? So these are some of the bigger movements on profit warnings, some of which are on multiples.
Yes, they are. And it's really interesting, actually. You know, if you look here, you've got JD Sports, which was one of our top 10 multi-baggers in that big study we did a couple of years ago. And that's had a bit of a kind of rocky ride for the last year or two. And Ultimate Products a few days ago was it's got some popular brands that I think they have all the Salter brands and other things like that. And they've had a bit of a rough time. And JD Sports, I think you said it's had multiple profit warnings in a row, hasn't it?
Three in a row. Yeah.
And, you know, maybe you can see there the decline on the profit warning. The minus signs here are the fall on the day. And I think by the time there's a sort of third one, they don't tend to fall as much. But IG Design, actually, it was their second profit warning, wasn't it? I think they had one they warned a few months ago, and then it had another one. It fell 58% or something, which is just the most brutal decline in a high-ranked share I've seen, I think, since DX Group. About 7 years ago. So I was quite shocked by that one, but it just shows, you know, you've got to use diversification in the market, because you can never, you never know what's going to happen. But yeah, some of these are just some that might be kind of known by a few people on the call. Solid State, you mentioned earlier, that was actually December profit warning, but we put it in because you'd flagged it. And I think they had more than one profit warning.
They have now. Yeah. There have been a few. I'm not sure if all of them were profit warnings as such. And actually, another question that we've had is not all profit warnings, not all of them announce profit warnings. They just miss expectations. And actually, sometimes it's not even a case of even missing expectations. It's a case. And I think Solid State, one of their announcements, I think the biggest dip was actually an announcement of the contract being pulled. I think that's why they were multiple, because they had to announce immediately that the contract had been delayed, was the first announcement, and then following up a week or so later with the impact that was expected to have on the actual numbers. So I think that's why they ended up having multiple warnings.
Yeah, I mean there is a question here from Nick Wortman. Is this mostly about profit? I see sometimes a miss on revenue or operating profits. It's very true. I think it often depends on how the company's being valued. If a company is being valued on revenues, because maybe it might not be profitable, but obviously, so it might miss expectations on the profit trajectory, and that can be really, really tough for the shares. Obviously, they're called profit warnings in the case, which is a subset of this, which is just about profits. But normally, companies are always generally valued on their, discounting their profits attributable to you as a shareholder from the future back to today's valuation. So when a company misses profits, or, sometimes they will use EBITDA, which we don't like as a number. Won't go into the details of it. It's kind of a management massage. Net profit really matters to you as a shareholder in a way. And, but if they're missing those numbers, it's never never a good thing, because most investors value shares as multiples of earnings. The PE ratio or dividend yield, which is the profit share paid out to you as an investor. So you got to keep an eye on the profits.
Absolutely. Final question we have here is there ability on Stockopedia to see which companies are due to announce in the next 30 days? We can't promise 30 days, but we do write every Friday on the companies that are set to announce in the following week. Weirdly, the calendars, I have found this year, the calendar for when companies are set to announce has got worse. So it's a bit of a minefield to figure out exactly what's reporting, who's reporting when. But yeah, we'll do our best, and hope maybe one day that will be one of the feature rollouts that you promised. Right? But yeah, for now, check out the week ahead every Friday, and that gives you the calendar of announcements for the coming week. That's all the questions that we have, unless there are any more that want to come in last minute. But we've done 40 minutes.
I think you should repeat your 3 rules.
We can repeat the 3 rules. We'll go back,
because I think that's the key lesson of the webinar, isn't it? Are we, just before we sign off, I think those are kind of very valuable. And if it's all about developing good habits in the stock market, if you consistently apply good habits in the stock market, you'll do better. So
yeah, and actually it's a very good point about the consistently applying good habits, because both Mark and I have talked recently about the fact that the mistakes that we made in 2024 were things that we knew, which is so annoying. But yeah, the 3 rules here are: look for companies which have announced or are on a streak of announcing positive updates. Look for big share price movements on the day of the announcement, and look for companies which are using the phrase significant in their updates, both on the positive and the negative, because those are the ones which see the biggest movements. Shadow's telling me it's time to stop. So I think we will wrap up there. But thank you very much, Ed, and thank you everyone for joining. I hope you gained something useful from this session, and let us know if there are any other topics that you would like for us to cover in future webinars. We'll keep these ones coming. Have a good evening, everybody.
Excellent. Thanks a lot. Good to see everyone. Bye.
Bye. Oh, Shadow. Did you come to the webinar? Did you come to the webinar? He's such a silly dog.